This fintech powerhouse is connecting billions in the emerging markets. This company is dLocal, ticker symbol DLO. And in this video, we're going to talk about whether you should be an investor in them or not. We also jump over here to the recent quarterly filing. We can see that total payment volume hit a astounding $8.1 billion. Now, reminder, this is a $3.1 billion company. They did IPO back in 2021 for 9 point some billion. So it is nice to see that they are pulling in a little over, you know, double what their current market cap is. 8.1 billion in total payment volume, 53% year over year increase, 217 million as of this latest quarter in revenue, 18% year over year increase, gross profit of 85 million, a 35% year over year increase, 58 million in EBITDA, net income of 47 million, and free cash flow of 40 million for this most recent quarter. If we move on over here to our next slide, we can see that they're also expanding their partnerships with Temu, Zeps, Rappi, and Hotmart. They also have major partnerships with Amazon, Spotify, Uber, Netflix, Microsoft, Booking.com, and Shein. So they are very widespread in the emerging markets. And like I said, bringing billions of customers together to buy these products on these online services. Their continued commitment to innovation, customer satisfaction, and expansion of our footprint throughout emerging markets allows us to maintain and strengthen the relationship with our merchants and ultimately increase our share of the wallet with them. So, if we pull over here to my High Five Snapshot now, let's get down to what this company should be valued at and why I think it's a buy today. I'm buying this company today because they are currently sitting at a low valuation of $10.90 based on today when I recorded this video, a $3.18 billion market cap, and I get a discounted cash flow model running a 15 and 20% free cash flow margin rate over the next 5 and 10 years, and with revenue growth rates of 20% or high teens over the next 5 and 10 years. We get an astounding $21 intrinsic value or fair value on this company based on a discounted cash flow model, which is a 49% margin of safety. So you're buying almost 50% below where this company should be priced based on their free cash flow. Now, the biggest reason this company is undervalued right now and it's being overlooked, what I believe, is because in a few quarters ago, they had this little hiccup with their free cash flow. Their rates kind of got thrown off with how much they're making in free cash flow, and it all came down to they work in emerging markets, so they get a lot of fees when they cross border funds between euro and dollar and yen, and they basically have all these different currencies, and there's fees with that, and basically it can cause some issues on the financial front with the fees and just the exchange over of the capital. So that's why they had that little hiccup. We can look down here, at our strengths, weaknesses, opportunities, and threats, and your bull thesis if you want to read that as well. But I do believe they're going to bounce back. The management and the leadership believes they're going to bounce back and has a plan to do that. But yeah, based on free cash flow yield, PE, PEG ratio, and discounted cash flow model, this is a buy today. Also, based on EPS, we're getting a fair value of $18.36, 40% fair value. And if we look at our discounted cash flow CAGR over the next 10 years and our EPS CAGR over the next 10 years, we're getting somewhere between 11 and 17% return if these assumptions are accurate. If they are accurate and you do believe them, which I do, then you have a triple buy. You have a buy on EPS, you have a buy on the discounted cash flow, you have a buy on the other metrics as well, and you have an overall buy on this company today. If we jump on over here to the charts, we can see that we did break out of this yellow line downtrend. As you can see here, we broke out of it, we retested, came down to the last stand area, which is the lowest this stock has ever been, down here to about $6.58. Like I told you, it IPO'd at a little over $9 billion market cap. It's gone down to 1/3 of that, down to $3 billion. And we're now working on breaking out over this second resistance or trend line that we've been having a little bit trouble of cutting through. Once we do cut through this up to $11 and $12 per share, then next we'll be on our way to this breakout. If we hit this breakout, then we will be looking at a move up to 1726, 2220, and 2530, which also includes your breakout of this cup and handle. And that's where you get the measurement of 2220. You get back to all-time highs here, or you get back to 52-week highs up to 2530. And like I said, I think there's a lot of room still to go. I think the great dip buy opportunity is down here in this $9 to honestly up to $11 range is where I would be buying. And I believe that you can continue to buy this name in a smaller DCA pool, right? So you buy bigger down here from 9 to 11, and then you start decreasing your DCA a little bit as you start climbing above 11 and 12 and 13 and so on and so forth. But I do believe that this name is on its way to breaking out. You can trade it, you can invest in it. I think it offers a great opportunity on the fundamental side and on the investing side and on the technical analysis side and the trading side. I'll be doing both in two separate portfolios, my trading and investing portfolio. And yeah, guys, I really like dLocal. I think it's a very it's an undervalued high five gem. I've been posting about it in my community. And if you like this type of content, guys, I'll continue to put it out. Drop a comment below on what stock you want to see next. Leave a like, drop a subscribe, and I'll catch you guys in the next